Good day, friends. Today we will discuss depreciation in valuation with case studies. It is part of cost approach. So we have already discussed first part of the cost approach in which we have discussed certain theoretical definitions, etc. Now we will be discussing this depreciation in valuation with case studies. This is an important topic. So what is depreciation? Depreciation. So depreciation is gradual exhaustion of the usefulness of a property. This may be defined as, this is an important thing you have to remember, that what is definition? This is decrease or loss in the value of the property due to structural deterioration, use, life, wear and tear, decay and obsolescence. This is an important thing which you have to remember, that this is decrease in valuation or loss in valuation. Why? Because of certain deterioration of in the building, use of the building, life of the building, wear and tear of the building, decay of certain components of the building, and up to certain extents obsolescence in the building. And then how it is measured? Depreciation is measured as a certain percentage of the total cost. This is how depreciation is measured. It is measured as certain percentage of the total cost. So basically what we do, first of all, we find annual depreciation. So what is annual depreciation? So it is annual decrease in the value of the property. First of all, we will find annual depreciation. It is general annual decrease in the value of the property. How it is find out, we will discuss in the coming slides. So as you know, as a building becomes older, then in order to find its correct replacement cost, we have to find out depreciated replacement cost. So what we do, first of all, we find the replacement cost of a new building, and then from that we deduct depreciation. That will give you depreciated replacement cost of the building. So how it is done? There are three methods of finding the depreciation. First method is straight line method. Second method is reducing balance method. This method is also called, sometimes it is also called constant percentage method or linear method. And the third one is sinking fund method. This reducing balance method is also called WDV method, which is also called written down value method. We will discuss these three methods one by one. First of all, we will discuss straight line method. So what is straight line method? So one thing in it you have to remember, that we assume that in this case we assume that property loses its value by the same amount every year. So here we assume same amount. Property reduce loses its value by the same amount every year. It is assumed in this method. So two things you have to remember. One thing is original cost. What is original cost? Original cost means replacement cost of new building, which we may call it replacement cost new. So replacement cost new, how can you find replacement cost of new building? You multiply plinth area of the building. First of all, you calculate the plinth area of the building. You multiply plinth area with the plinth area rate of your respective state or any other rate which is prevalent in the local market. So you calculate plinth area, you multiply it with the plinth area rate, that will be your original cost. And then scrap value or salvage value, you know it is a value which is at the end of the economic life of the building, the value of the building at the economic at the end of economic life of the building. So two things are known to you. The third thing, life in year. So in IBBI questions you will be given life in years. Otherwise, for load bearing structures you may take it as 50 to 60 years. For framed structures you may take it from 70 to 100 years, and for industrial structures which are of uh, steel structures we may take the life as 40 years. So by using this formula you can find annual depreciation. This D is annual depreciation. So you find annual depreciation, you deduct scrap or salvage value from the original cost and divide it with the life in years. That will give you annual depreciation. So the total depreciation, that will be equals to annual depreciation multiplied by age of the building. So what is the age of the building? So it is the age of the building on the date of valuation, on the date or year in which you are doing valuation. So you have to find out age of the building. So you need to have one thing, original cost or replacement cost of new building minus scrap value should be known to you, and life of the building, it should be known to you, and then you must know the age of the building. By using these four things you can find the total depreciation. So this depreciation will be in percentage. That will give you percentage. This will be in percentage. Percentage of what? Original cost. Percentage of original cost. So this is depreciation method. Then we will take some case studies that will make the things clear to you. Then the second method is linear method. It is also called constant percentage method or reducing balance method, or sometimes it is also called written down value method. So written down value method is generally used by the accountants for writing value of the asset in books of accounts. So what is the difference? There we were assuming that building depreciation by same amount every year. But here, remember in this we assume percentage remains constant throughout the life of the building. We assume that value of the building depreciate by same percentage every. So remember here depreciation percentage remains constant. So how you find out depreciation in this case? One thing, there the amount was constant, here percentage is constant, and as far as amount is concerned it will go on reducing every year. It will go on reducing every year. How we will be calculating that we will discuss now. Let us suppose C is original cost of or replacement value. You know how to find it. S is scrap value or salvage value. N is life of the property in years. And here we assume P as constant percentage of depreciation. So in the value of the property, it is at the start of the life, at the start. At means at the start at 0 years, means at 0 year life value is C. So the value of the property at the end of first year, it will be C minus P into C. So P is the amount by which the percentage by which the value depreciates. So the value at the end of first year, it will be C minus P into C. So you take C as common, it will be C into 1 minus P. So similarly the value at the end of second year, it will be, so now the depreciation in the second year will be applied at this amount. So now sorry, on this amount. So C into 1 minus P is the value at the start of second year, And this is the depreciation, C into 1 minus P multiplied by P. So it will be, if you rearrange it, it will be C into 1 minus P square. So similarly, if you have to calculate value at the or the property at the end of life, economic life or whatever life you are taking, if it is n years, so it will be C into 1 minus P raised to power n. So, but value of the property at the end of n years means when the life comes, economic life comes to an end, it is equals to salvage value. We assume salvage value is s. So C into 1 minus P raised to power n, what we have discussed in the last slide, it must be equals to s. So if you have to find P, you take C on the other side and if you rearrange it, so P will be equals to 1 minus S upon C raised to power 1 upon N. Remember. So now if you know the value is C into 1 minus P raised to power N at the end of economic life. But if you have to find the value in between, so 0 and N, and if you have to find the value at any age in between 0 to n, so the value will be equals to C into 1 minus P raised to power m. So n will be replaced with m. It is also called written down value. Written down value is what is the value which is written in the books of accounts of a company. And now if you want to rearrange it, we can put the value of P here. You put the value of P in this equation, so it will be C into 1 minus, in place of P you can write 1 minus S upon C raised to power 1 upon N, and if you rearrange it, 1 minus S upon C raised to power M upon N, so you will get this equation. If you rearrange it, you will get this equation. So value of the property at the end of m years, it will be C into S upon C raised to power m upon n. But remember, this formula will be useful only if S is not equals to 0. Means if salvage value is not equals to 0. If salvage value is 0, so this whole thing will become 0. So this formula cannot be used in that case. So generally in case of insurance, salvage value is assumed to be equals to 0. So you have to remember this thing. So this is one equation which you can use if the salvage value is known to you. Otherwise you can use this formula. If the percentage is known to you, you can use this formula, C into 1 minus P raised to power m. You can use this formula. If percentage of depreciation is known to you, you can use this formula. And if salvage value is known to you, you can use this formula. So two formulas you have to remember in this case. So this we have already discussed, that value, written down value at the end of n year, C into 1 minus P raised to power n, and written down value at the end of m years means in between 0 to n, at any age m, so it will be C into 1 minus P raised to power m if percentage of depreciation is known to you, where m is age of the building, here n is life of the building. These two things you have to remember. And then the third method is sinking fund method. In sinking fund method, it is basically uses compound interest. So one thing you have to remember, in the first two cases we were assuming depreciation as consumption or usefulness of the property, but here it does not take into account consumption of usefulness of the property. It is not taken into account. Basically what it assumes that if you are using sinking fund, if sinking fund is being deposited, it will lead to recovery of capital. So sinking fund means it will leads to recovery of capital. So the difference between sinking fund and depreciation is that it allows recovery of capital while there is no such provision in the depreciation. So in the first two methods there was no provision for recovery of capital, but in this method, in the third method, sinking fund method, it allows recovery of capital. So in this method, depreciation of property is assumed to be equal to the annual sinking fund plus the interest on the fund for that year. Basically, instead of fund for that year means up to that years, we can say up to that years. How it is calculated, we will discuss it now. So it is calculated in the first step. You have to find sinking fund coefficient. So for sinking fund coefficient, you know it is equals to IC. IC is equals to R divided by 1 plus R raised to power n minus 1. So where R is rate of interest. We will be assuming a suitable rate of interest for sinking fund. So this sinking fund is calculated for total life of the building. Remember, you have to calculate IC for total life of the building. In the first step, you find out IC, and in the second step, you find how much amount, if you are assuming you are this how much amount it has accumulated. So to find the annual sinking fund at suitable rate of interest for the total life of the building, you have done it. And then the second, you have to find accumulated amount by depositing the annual amount of sinking fund. So you find out the value of S. It is 1 plus R raised to power n minus 1 upon R. So now here n is age of the building. In the first formula, it is life of the building, total life of the building. Means you remember, you have to accumulate a sum for total life of the building. But when you are doing depreciation based on sinking fund, so you remember that up to that year how much sum has been accumulated as sinking fund. So there you will be using n as age of the building in this formula. So you find IC, and S, you multiply with IC into S, that will give you depreciation. Otherwise, if you have to convert it into percentage, you can multiply it with 100 if somewhere depreciation in percentage is required. So you know, in the cost approach, how you calculate the value. There are two things involved. One is land, and second thing is depreciated replacement cost of the building. So as far as so total value of the building is land plus depreciated replacement cost of the building. So as far as land is concerned, you know you will be using the market approach. So market approach, in market approach, what we do? First thing, you identify comparable sales. So you go for inspection of the property of which you have to do the valuation. You identify some comparable of similar parcels of land in the same or comparable location. These are known as comparable. Then you know you may use any method for a market approach. First thing you have to do, you have to adjust for differences. So adjust the sale prices of comparable to account for differences between them and the subject property. Factors you may consider as size, location, zoning, and any unique feature you have identified at the site. Then you analyze the market trends, that how the markets are moving on the date of valuation, and current market trends, conditions that might affect the land values, such as economic factor, development activities, and changing on zoning law, etc. And then you determine the value of the building by adjusted sale prices and giving a weighted average. As you know the method of market approach very well. So we will be discussing it as far as this topic is concerned. Here we have just reference to this, how the land value or market approach is calculated. And then the main thing which we have to discuss here is building value by cost estimation method. The first thing, you estimate the replacement cost or reproduction cost. So first thing, you must know whether you are doing replacement or reproduction. So in replacement, main thing is that you have to consider building a structure with the same utility by using modern materials. While in reproduction cost, you have to produce an exact replica. So in replacement, you may use modern material, modern architect, etc. And main thing is the building should have the same utility. But in reproduction, if you are calculating reproduction cost, you have to produce an exact replica using original materials. Remember this thing. So first you calculate a replacement cost or reproduction cost. You calculate, we have already discussed that you calculate plinth area rate, plinth area, and then multiply it with the replacement or a reproduction cost, whatever thing you want to find out. Then you calculate depreciation by using any of the three methods. Then from here you will be calculating depreciated replacement value of the building. To this depreciated replacement value of the building, add the land value. That will give you the final value of the building or overall value of the property. So these are the three methods we will be using. Now we will discuss some of the examples that will make the things clear. It First example is, it is a load bearing structure. It is 20 years old. Plinth area is 1275 square feet. Replacement rate is 1650 square feet. What is the depreciated value? See here, what you have to find out, depreciated value. So there are two things. What is one is depreciation value. Second one is depreciated. So you have to concentrate what he is asking in the questions. Here he is asking you depreciated value of the building. So life is given to you 60 years, always value is 10% by adopting straight line method and by adopting constant percentage method. This is given to you. First thing, you please write down what is given to you so that you are able to find what you have to look for. So plinth area is 1275 square, age is 20 year, life is 60 years, salvage value 10%, replacement rate is 1650 square feet. So you calculate, see here, you multiply plinth area with the replacement rate 1650. That will give you replacement cost. So this is replacement cost 21 lakh 3750. So salvage value is 10%. 10% means 10% of 21 lakh 3750. It is 2 lakh 10,375. Now you are using we are using two methods. First is straight line method, second one is constant percentage method. In straight line method, you know the formula, d is equals to sc minus s upon life. C is 100% life, s always value is 10%, life is 60%. So you calculate depreciation per year. So depreciation per year will be 100 minus 10 divided by 60. It is 1.5% per year. So this is per year. So age of the building is 20 years. So the total depreciation will be 1.5 into 20, 30%. It means 30% cost has depreciated. So we will call it depreciation cost. See, it is depreciation cost, which is 30%. 30% of what? 21 lakh 3,750. So it is 6 lakh 31,125. So second thing, you have to basically you have to find depreciated value, not depreciation value. So this thing you have to remember. So you have to find depreciated value. So 30% has depreciated. It means remaining value will be 1 minus 3.3, means 70% will be depreciated. So see the difference between depreciation and depreciated value. So it is 70% of 21 lakh 3,750, which is 14 lakh 72,625. This is by straight line method. And if you are using constant percentage method, You know the formula for depre. So it will, see here, you have to use 1 2 3 4 steps to find arrive at a depreciated value. But it, this formula, it will directly give you depreciated value. This constant percentage method, this will directly give you depreciated values. You will directly come to this point. So the formula is C into S upon C raised to power M upon N. C, you know, original cost 21 lakh 3,750. S, salvage value 2 lakh 10,375 divided by original cost 21 lakh 3,750 raised to power M. M is age, which is 20, and N, life, which is 60. You put all the value, it is 9,76,475. See here, here the value is 9,76,475 by constant percentage method, and by straight line method value is 14,72,625. So it, both the methods will never give you the same value. Some may give higher, some may give lower value, and in this case it will give you, constant percentage method will give you depreciated value. And if you have to find depreciation cost, then what you have to do, you have to deduct depreciated value from the original cost. That will give you depreciation cost if you require to find out. Another example, building area is 1200 square meter, age is 25 year, life is 50 years, salvage value is nil. See here, here salvage value is nil. So you know here salvage value is nil. What does this mean? It means you cannot use the same formula for constant percentage method which we have used in the first example. There, if salvage value is 0, so total value will become 0. So here we have to use some other formula. Plot area is 200 square meter and land rate is 8,000 square meter. Replacement cost of the building is 25,000. What is the value? What is the value? Value means value of land plus value of depreciated replacement cost of the building. So value of the buildings, you can find out formula for depreciation. You know C minus S upon life. You put all the values, 100% C is 100%, life is 50 years, always value S is equals to 0. So 100 minus 0 upon 50, depreciation per year is 2%. Life is 25 50 years, but age is 25 years. So total depreciation will be age into depreciation per year, 2 into 5 25, which is 50%. So depreciation 50% of what? 50% of value of the building. Value of the building will be 1200 is the area, and rate is 25,000. So 1200 into 25,000, it will be 3 crore. So depreciation is 1 crore 50 lakh. So depreciation is 1 crore 50 lakh, means 50% has depreciated. So depreciated value will be, again it will be 50%. So 50% depreciated, the balance value will be 50% of 3 crore 1 crore 50 lakh. So this is depreciated value of the building. So land value, what is land value? Land area is 2000 square meter and land rate is 8,000 per square meter. So it will be 1 crore 60 lakh. So 1 crore 50 lakh is the value of the building plus 1 crore 60 lakh is value of the land. You add both of them, it will give you 3 crore 10 lakh. But in constant percentage method, as in salvage value is 0, we can not use the formula which was used in the first example. So here we assume P is equals to 0. Oh, sorry, 2%. So you know the formula, C is E into 1 minus P raised to power M. Depreciation rate is 2%, age is 25 years, original cost is 3 crore. You put all the values, it value of the building, depreciated value of the building becomes 1 crore 81 lakh 3,941. So total value, land value plus depreciated value of the building. So depreciated value is 1 crore 81 lakh 3,941 plus land value is 1 crore 60 lakh. So total value 3 crore 41 lakh 3,941. So see here again. Now, if you are using percentage, With the same percentage, you are getting higher value, and this is giving you lower value. So both the methods will never give you the same value of the building. Third question. The plinth area of a RCC roofed load bearing residential building is which is 16 years is 1200 square feet and the life of the building is 60 years. Always value is 10%. Calculate the depreciated value of the buildings. What you have to find out depreciated value if the unit replacement rate is 1800 per square feet. From the above building, for the above building, if the age of first floor is 10 years, what will be the depreciated value of first floor of built up area of 1000 square feet, assuming the unit rate of construction as 1400. So for ground floor, unit rate of construction is 1800, for first floor rate is 1400, and salvage value is 10%, life is 60 years, area of the ground floor is 1200 square feet, and area of the first floor is 1000 square feet. Now remember here, when you are doing questions like this, you have to check though the age of the first floor is 10 years. But here, as when you are calculating depreciation, for depreciation you will assume its age is depreciation for first floor also. You will calculate depreciation for 16 years. Why? Because both ground floor and first floor, both ground floor and first floor have same foundation. If the foundation is same, depreciation will be for the same year. So you have to consider this thing. You have to consider the age of the foundation, not the age of the building. For depreciation, remember, you have to consider age of the foundation. If so, in this case, age foundation is same, so depreciation for both ground floor and first floor will be calculated for 16 years, not for 10 years for the first floor. So this is a given data, age is 16 years and 10 years for first floor, life is 60 years, always value is 10%, plinth area, ground floor 1200 square feet, plinth area, first floor 1000 square feet, replacement rate, ground floor 1800 square feet, replacement value, ground floor it will be 1200 into 1800, 21 lakh 60,000. For first floor, rate is 1400, so 1000 is the area, rate is 1400, so it will be 40 lakh. So for straight line, you know, first of all you find out depreciation per year. So depreciation per year you put 100%, life is 60 year, and salvage value is 10%. Here it is given 100 minus 10 upon 60, 1.5%. Age of ground floor is 16, so depreciation will be 24%. So depreciated value of ground floor, find out, for that you first find out depreciation value. It is 24% of what? 21 lakh 60,000, which is 5 lakh 18,400. So depreciated value 24% has depreciated, so balance will be 76%. 76% of 21 lakh 60,000, which is 16 lakh 14,600. Similarly, you find out the value of the first floor. So depreciation, now here we have already discussed that the foundation is same, so for the foundation same percentage of 24% will be applied on the this amount. 14 lakh means 3 lakh 36,000. So 24% has depreciated, means balance is 74 6% of 14 lakh 10 lakh 64,000. So here in the constant percentage method, you know the formula. C is 20 for ground floor 21 lakh 60,000, S is 2 lakh 16,000, salvage value 10%. You put the formula C into S upon C raised to power M upon N. You put all the values, 21 lakh 60,000, 2 lakh 16,000 is the salvage value divided by 21 lakh 16,000. So 16 is the age and 60 is the life of the building. So here it comes to 11 lakh 68,927. Similarly, depreciation for first floor. So it will not, though it is of 10 years, we will apply the same depreciation year 16 year as the foundation of other, both are same. So original cost is 14 lakh. Salvage value is 1 lakh 40,000. C into S upon C raised to power M upon N. You put all the values. 14 lakh into 1 lakh 40,000 upon 14 lakh raised to power 16 is and 60 life. It is 7 lakh 57,638. So see, compare these values. Here it is approximately 11 lakh 68,000, and here value is 16 lakh 41,600, and the second it is 7 lakh 57,000 and it is 10 lakh 64,000. So both are not giving you the same values. So now we'll be taking an examples that will make the things clear that how these three methods calculate values internally. A temporary shed has been constructed for rupees 1,20,000, assuming the salvage value at the end of 6 years as 30,000. Determine the amount of depreciation and book value by straight line method, constant percentage method, and sinking fund method. So first we will be using constant percentage method. For constant percentage method, you know the formula D is equal to C minus S upon life. C is 1,20,000 original cost. S is given to you as 30%. So now it is not percentage, it is given as 30,000, and life is given to you 6 years. You know the formula depreciation per year. Per year depreciation 1,20,000 original cost minus salvage value divided by life C minus S upon N. It is 15,000 per year. So see how we will be calculating book value by this formula, this method. At the start, value is 1,20,000. At the end of first year, depreciation will be 15,000, which we have already calculated. So total depreciation, yeah, otherwise you can say cumulative depreciation is 15,000. So the book value will be 1,20,000 minus 15,000, 1,05,000. In the next year again, a depreciation of 50,000 will be applied. So total depreciation will be 15 plus 15, 30,000. So value will be 1,20,000 minus 30,000. It is 90,000. Again, at the end of third year, a depreciation of 15% will be applied. Total depreciation will be 45,000. So 1,20,000 minus 45,000, it will be 75,000. In the fourth year again, 15,000 depreciation. Total depreciation will be 60,000. 1,20,000 minus 60,000. 60,000 will be the book value. Again, at the end of fifth year, a depreciation of 15,000, total depreciation 75,000, 1,20,000 minus 75,000, 45,000 book value 45. And again, at the end of sixth year, depreciation of 15,000, total depreciation 90,000, 1,20,000 minus 90,000, it is 30,000, which is your salvage value. See here, every year, same amount, the asset depreciate by same amount every year. So see here how this straight line method works. I think this example have made the things clear how this straight line method works. Now we will see how the second constant percentage method works. See here, the formula for P, you know, we have already discussed how you can calculate the percentage. For calculating percentage, formula is 1 minus S upon C raised to power 1 upon N. C is original cost, which is 1,20,000. S salvage value is 30,000. N is 60 years. You put all the values here. 1 minus S 30,000 divided by C 120, 1,20,000 raised to power 1 upon 6. You calculate it. This is the percentage per year, which is 0.2064. So see, at the start the value is 1,20,000. So at the end of first year, a depreciation will be 1,20,000 multiplied by this 0.2064. So that will be 224,768. So book value will be 1,20,000 minus 24,768, 95,233. So now in the next year, depreciation will be applied on this, not on 1,20,000. It will be applied on 95,232 multiplied by 0.2064. It will give you 19656. So 95232 minus 19656, it will be 75576. In the next year, now depreciation will be applied on 75,576 multiplied by 0.2064. It will give you 15,599. So 75,576 minus 15,599, it will be 59,977. Again, in the next year, depreciation will be applied on 59,977 multiplied by 0.2064. It will be 12379. So 59,977 minus 12379, it will be 47,598. So again, now here depreciation will be applied on 47,598 multiplied by 0.2064. It will be 9824. So 47,598 minus 9824, it will be 37,774. In the next year, 37,774 multiplied by 0.2064, it will be 7797. So multiply it, 37774 multiplied by 0.2064, it will be 7797. So 37,774 minus 7797. At the end of sixth year, you will be having value approximately equals to salvage value, which was 30 years. Now see here, amount is decreasing every year as the life increases, but the percentage will remain same, which is 0.2064. This is a point to be noted in this case. Now the third method, which is sinking fund method. For sinking fund method, you know you have to use this find IC, which is R upon 1 plus R raised to power n minus 1, where n is total life of the building, and S 1 plus R raised to power m or n, whatever you may say, minus 1 upon R, where m is age of the building, and depreciation percentage is IC into S upon 200. So let us assume this R equals to 4%. So if you put this as 4% in this formula, IC will remain same for all the years. See that whether it is 0, 1, 2, 3, 4, 5, 6, this IC value will remain same. But S will go on changing. So you have to find, first you have to put M equals to 1 for first year. For second year, M will 2. For third year, 3. For fourth year, 4. For fifth year, 5. And for sixth year, M is equals to 6. You will have to calculate value of S for all the 6 year, 1, 2, 3, 4, 5, 6. Now see here, salvage value is given to you as 30,000. What does this mean? It means what amount you have to accumulate as sinking fund. It is not 1,20,000. It is 1,20,000 minus 30,000. You have to accumulate a sum of 90,000, which is important to remember. So if you calculate IC into S for the first year, you will you can first thing you have to remember, we can write is 1,20,000 as 90,000 plus 30,000. 30,000 value will remain same in throughout the years. So you will get at least 30,000 as salvage value, whatever is the age of the building. So you can write it as 90,000 plus 30,000 instead of 1,20,000. Now see, IC into S for the first year will be 15%. So you have to apply Depreciation on what amount? At 90,000. 90,000 into 15%. 15% of 90,000 is 13,500. So what you have to do? You have to deduct 13,500 from 90,000. Deduct 90,000 minus 13,500 plus 30,000 will remain as it is. So the value at the end of first year will be 1,06,500. And in the second year again, now the value depreciation IC into S is 31. It will be applied on 90,000. 90,000 into 31%, it is 27,900. So what you can do, 90,000 minus 27,900 plus 30,000, which is salvage value, you will get 92,100. Similarly, at the third year, depreciation will be 47%. 47% of 90,000, which is 42,300. So 90,000 minus 42,300 plus 30,000, it will be 77,700. And at the end of fourth year, IC into S will be 64%. So 64% of 90,000, it is 57,600. So 90,000 minus 57,600 plus 30,000, it is 62,400. And then at the end of fifth year, it is 82% IC into S. 90,000 minus 73,800. 82% of 90,000 is 73,800 plus 30,000. So this amount will be 46,300. At the end of sixth year, 100% will be the depreciation, means 90,000 will be the depreciation. 100% of 90,000 is 90,000. So you will be having 30,000. 90,000 minus 90,000 plus 30,000, you will be left with an amount equals to salvage value. See here how the sinking fund method works. So this question is important. You may not get the similar type of question in your IBBI examination, but it is just to make you understand how the all the three methods works internally. So now we'll be taking another example that will make the things clear that how the all the three methods works and what is the difference between the values of these three. The cost of a newly constructed building was 1,50,000. The life of the building is 75 years. Determine the depreciation in 30th year of the life by straight line method, by constant percentage method, by sinking fund method at 8% compound interest. Scrap value is given to you as 10% of the construction cost. So we'll be using all the three methods. First, state this is age 30 year, life 75 years, salvage value 10%, construction cost 1 crore 50 lakh, scrap value or salvage value is 10% of 1 crore 50 lakh, which is 15 lakh. So you know the formula for straight line, C minus S upon life. C is 1 crore 50 lakh, life is 75 years. You put all the values, 1 crore 50 lakh minus 15 lakh upon 675. So depreciation per year is 1,80,000. So total depreciation age of the building is 30 years. So this is given to 30 years. So total depreciation is 54 lakh. Constant percentage method, you know, it will directly give you depreciated cost. It will not give you depreciated value. So you put the formula C into S upon C raised to power M upon C is 1 crore 50 lakh multiplied by 1 lakh 50,000 divided by 1 crore 50 lakh raised to power M is 30 and N 75. It is approximately 59 lakh 72,000. So it is depreciated cost. But he has asked you to find out depreciation. So what will be depreciation? It will be original cost minus depreciated cost. 1 crore 50 lakh minus 59 lakh 72,000. So 90 lakh 28,000 is the depreciation. This is depreciated, this is depreciation. So the third method is sinking fund method. You know, formula is total, first thing you have to find out how much sinking fund you have to accumulate. So you have to accumulate a sum of 1 crore 50 lakh minus 15 lakh, which is salvage value. So basically, instead of 1 crore 50 lakh, you have to accumulate a sum of 1 crore 35 lakh. First thing you have to remember in this formula is find out how much amount you have to accumulate as a sinking fund. Then you know the formula for IC, which is R upon 1 plus R raised to power n minus 1. In this formula, n is age of the building, and S 1 plus R raised to power m upon n minus 1 upon R, where m is age of the building. So age of the building, you know, age is 30 years, n is 75 years, R, you know, 8% means 0.08. You put the values in the formula, you will find IC as 0.00025 and S as 13 point. IC will be 0.00025, S will be 113.28. You multiplied both of them, it will be IC into S 0.0283. So you multiplied this. Now you have to multiply this with the amount which is to be accumulated, not with 1 crore 50 lakh. So 0.0283 multiplied by 1 crore 35 lakh, it is rupees 3 lakh 82,086. So see here, depreciation is only 3 lakh, or so you can say approximately 4 lakh. Here the depreciation is 90 lakh. Here the depreciation is for 54 lakh. So sinking fund method will give you the lowest depreciation in all the methods. From here you can check. So this method is basically used when CBDT has allowed to use it when you are calculating capital gain tax. So they have allowed you to use this method. So by this the depreciation will be the lowest, and that will give you the highest value of the building, highest depreciated replacement value of the building. So this is all about depreciation and method of depreciation. So have a good day, friends, and if you have any doubt, you can consult on the phone numbers given at the beginning of the slides. Thank you very much. Have a nice day.